There's a great website called tradingeconomics.com. You can look through different things at a glance, and you can look at countries, which we're going to do now, or you can look at different markets and forecasts and so on. Let's just have a look at the countries, and we're going to focus on some of these numbers. And here we've got the United States. We're looking at the indicators for the United States. Let's have a look at GDP growth rate, 2.7, and we're going to look at inflation, 6.4, and the interest rate, 4.75, and rising rapidly still. Now, I want to compare this to, let's say, Europe and the UK, because I want to look at the dollar index and the influence of these numbers on the dollar index. Let's have a look at the euro, and we'll look at the same numbers. GDP, much lower, and unemployment rate, much higher, inflation rate, much higher, and interest rates, a lot lower. All of that points to a weaker euro and a stronger US dollar. We've got all of those key numbers are worse in terms of the euro and in favor of the US dollar. So we've got GDP, we've looked at, worse in the Eurozone. Unemployment is worse. The inflation rate is significantly higher. And the interest rate is significantly lower. Interest rate affects the currency in that a higher interest rate affects carry trades and favors countries with higher interest rates. We've got the US high and rapidly rising, but a lower inflation rate and a higher GDP. So that's the Eurozone. And then let's just have a look at the United Kingdom, Great Britain, and these numbers are even more interesting. GDP, well, very close to zero. Unemployment, not too bad. Inflation rate through the roof, over 10%, and interest rate low compared to the US. So once again, all in favor of the United States dollar when you have a look at it. Now we're going to have a look at dollar index in comparison to these numbers, and dollar index has fallen down to a low at 100, around about 100, just above 100 at that support level, 100.6 to be precise. We formed a sharp bottom, consolidation around these moving averages for a number of days, and now rising and set to rise to 105 and probably 106 and possibly 107 and maybe even 109.50. That's the 78.6% Fibonacci level. I'm just eyeballing this very quickly. These aren't precise numbers, just rough numbers. But first of all, we've got 106, where these two moving averages, the 200-day and the 100-day moving average, coincide with a 38% retracement. That's a sensible number to aim for. We're at 104.60 now. This is 106. So that's 150 pips, roughly in terms of currency terms, or 1.3% higher in the dollar. And probably we'll go to 107.50 from 104.50. So that's a 3% rise. That means a 300 pip drop in the euro and the pound and so on. That's the overall strategy. So in general terms, sell rallies in the euro, sell rallies in the pound, sell rallies in the Australian dollar, and the Canadian dollar, anything else that you can find to sell against the US dollar. I think we're going to see the US dollar moving higher at the very best case scenario up to 109, but probably 107.50, 106.20. Those are the levels to be looking out for. So we're going to see a 1.5 to 3% rise in the dollar and a commensurate drop in the euro and the pound and the rest of the majors against US dollar. Just food for thought. May not work out. Sometimes these things look obvious, but they turn out not to be.